Good day, guys. Uh, Welcome back to another episode of my YouTube series. So, on X, I think last week, I asked you guys to suggest a topic I should treat, and most of you suggested I talk about time and price theory. So, basically, we'll be talking about time and price today. Time and price. And this is like one of the most important topics you need to understand. Because if you look at the charts, all of these candlesticks, right? We are saying all of this structure and all of these things, the major source of everything, the foundation, as a result of time and price, because this is the chart basically. So if you look at your x-axis and the y-axis, on the y-axis, that is where we have what? We have the price, and on the x-axis, we have the what? We have the time, basically. So everything that formed within the charts are just what? Are the sum of these two stuff, x-axis and y-axis, which is the what? Time and price. So, which make us understand how important this particular topic is. So now, moving on, we're going to start as soon immediately. Moving on, we need to understand that the whole price action, and no matter the kind of concept you trade, support and resistance, ICT concepts, what is it called? Smart money concept and everything. There is one thing that is constant. Everything will turn back to what? To power of three. So, which means that to understand time and price, we need to understand the power of three first. You understand? Because at the end of the day, this is all you have at the end of every price action. Because every candlesticks that contain everything we are looking for in the chart, we always end up like this. So the candlesticks are what form the structure, what form the charts, the pattern, and all of just and everything. So the same thing, this is how you get that candlesticks. This is how the candlestick form. That is, for my markets, for a weekly market, market will open for a weekly chart that is bearish, right? It means that market will open at a price level, right? At a price level. Then, before the expansion, what do you think? Market will move to manipulate. And this is where we have our wick. And after that, we have the what? The expansion, total expansion of that wick candle. Then later on, what do you think what market will do? Market will do what? We close at a particular price level. So the opening price is like the price level a weekly candle will open, right? And above it is where we get the high of that particular week. And that is why we have the week above this particular price level. And it's always above what? Above the opening price. So at that time, we have what? Our expansion. And after expansion, we have the market reaccumulate and close like this. So which will make our candlestick formation be like this, an ideal bearish day. You understand? Which means that you have the open, the high, the close, and the low. Let me put it. You have the what? The open, right? We have the high of that particular candle. And we have the what? The close. This is the close. We have the close. and below we have the what? We have the low. This is everything that happens in the market every day, every week, every month, every year. Did you understand it? So if we're going to be talking about anything about time and price, there's no how we would not visit this particular topic again. So we have the high, the open, the close, and the low. So time and price will make you understand when it will make you understand the time of the opening price, right? The particular price the market open with, the high and what time, right? The expansion when and what the close of that particular candle. Everything here is about what? Time and price. If you know when the high will form, that is the time and at what price level. If you know when market will open and you understand how to use opening price, right? You understand that, okay, once market open and you are looking forward an expansion to the downside, the time you need for that expansion to up will be above the what? The opening price. That is where we have the high. So as long as you understand this particular formation, then we can move on. Do you understand? With this. So now, if we look at we'll check the higher time frame, the monthly candle, and as a matter of fact, price is fractal, which means that the same thing we find on the higher time frame, we can also find them on the lower time frame. So if we talk about a monthly candle, definitely the same thing can happen to what? To a weekly candle, and the same thing can happen to what? To a daily candle. So now, this is our expectation every day. So how do we anticipate a candle and all the opening, high, low, the expansion, and all of this? How do we anticipate it? Number one, if you are looking to go bearish on a particular pair on any asset, you tend to sell at opening price or above the opening price. But most of the time, it is always better to sell above the opening price because why? You can then anticipate a few manipulations to form what? To form the wick. Do you understand? So that when market open, you can anticipate just maybe like few pips above the opening price, right? Market open at this point, they can anticipate few pips above the opening price for the market return to its normal directional bias or go where you are expecting it to go. Do you understand? So and if we move to higher time frame to talk about this, you will see that it's still the same thing. Just let me just quickly make us understand one or two things. This is monthly time frame, right? Okay, now let's look at a monthly swing you can use for example. Now, looking at this now, looking at the price action here, right? We've seen markets trying to change bias here, right? We can use this, we can use this, and we can use this. We can use any price action here or any swing. So if you consider to use this swing, you will see that after market seek the sell side liquidity here, and we can see market form a swing low just to expand above. But that is not what I want to bring out here. What I want to bring out here is to always see how market and weekly candle open and closes. Now, this is the moment the expansion started because we have this particular candle above this particular high, which is confirming what? Which is confirming a bullish trend, right? So the moment you have this already, now we can anticipate a higher prices. Now look at every candle that opened after confirming a break of structure here and your swing low here. And you're seeing this candle breaks above this, automatically suggesting that okay, we can keep moving higher. So if you look at every time market open, what do you think happen? Market will go down and expand, and market will reject and close, right? So if you look at the next candle again, market open, then do what? Rejected. Then after that, we have the expansion and market close again. If you look at this again, the same thing. Market open, rejected, and what? And expand, and also what? And close again. So what I'm trying to bring here is that every time market open, we always until if you are bullish on a particular pair, maybe weekly or monthly or daily. Each time the market open, it is always advisable to do what? To buy above or to buy below the what? The opening price. You can see here, when market open, you have the rejection. So we have anticipated this and buy. The same thing, market open, rejected below the opening price, buy. Market open, rejected below the opening price, buy. Market open, rejected below the opening price, and buy. Do you understand? So if you look at every time you have a clean directional bias, it's always like that. If we move this particular one to this point too, you will see that it's the same thing. Market open, small rejection and buy, and market open again, small rejection and buy. This is why I said it is always advisable to buy below the opening price. And if you want to be a seller, to always sell above the what? Above the opening price. But ideally, market can actually sell or buy even at opening price. I think I have one example here. I saw one. Look at, yeah, market opened and what? Dropped immediately. So it happened like that sometimes, but most of the time, this is how we should anticipate it. So if you have this ideology in your head, and this is a weekly, this is monthly time frame. If you are bearish, or let's say you are bullish on monthly time frame, automatically on weekly, you can always wait for market to come below weekly low. Once market open in 1 week, below that particular weekly low, you can look for a trade opportunity. Do you understand? As long as you know you are still bullish on monthly. And even on weekly, when you are actually bullish on weekly time frame, right? When you are bullish on weekly time frame, you can always do what? You can always wait for market to open on daily time frame and do what? And buy above the what? The opening price. I want to quickly pause the video to do something. Yeah, so moving on. If you look, if you let's say you are bearish on a weekly time frame, right? For example, market is approaching a draw on liquidity, and you are expecting the market to run this particular liquidity, which means that you'll be bearish for the beginning of that week. Definitely, if you go to if you go to daily time frame, you can anticipate a sell above the opening price of a day candle. Do you understand? So ideally, that is how to use time and price, in the sense that you time, you know what time you should be expecting market to expand, and you know that when market open, you are supposed to be looking for an opportunity above or below the opening price, depending on what, on the directional bias, right? So logically, let's move on to session, because I know that is what most of you are expecting. A London session, New York session. Oh, that is not the only way to understand opening price. Be to understand time and price, right? Time and price is all about what is going on in the market, the candlesticks that form every single candlesticks. You can understand it better by understanding the opening price and the expansion, how candle open, close, highs and low, all of those things. So if we move to let me remove the drawing. If we move to a lower time frame, we'll be discussing session, right? We'll be discussing session, and we'll start with the New York session, because I really don't want this video to be really long, right? So we'll start with the London session, basically. London session. Session. You know, we have London session and we have New York session. And before I move on, I would advise you, or let me say, whatever time it is in your place, your time zone, you can only do the conversion. But the way I trade, I use New York time, which you can, if you want to follow me with the time zone, right, you can just click on this particular UTC -5. You see New York time. So click on the New York time. So this is the time I use. It's not in Nigerian time, but that is the time I use to understand price action, and that's actually from ICT. So cool. And that is the same thing I'll be using to explain this. So we talk about the London session, and we'll talk about the New York session, right? We'll talk about the London key zone and the New York key zone. So there are times in the market that you always expect the what? The expansion. So you won't just be in the charts when the market is consolidating, or when the market is not even moving fine to you, right? So those kind of time, you can always avoid the market. So there's now key zones. Key zones are now specific time where you will definitely get the expansion of that particular session. Do you understand? For example, you are in London session. In London session, there's key zone. That key zone is the time. Do you understand? It's the time where you can anticipate an expansion. For example, London session now, we all agree that London session form the highs or low of the day, right? So if after your analysis, your daily is suggesting lower prices, that is, you'll be bearish on the daily time frame, then it means that during London session, you can always find a way to get your entry, because that is when you can have a better chance of better entry for the day, since London session will form the what? The high or low of the day. You understand? So if you understand that already, you can always then take it back to the idea that when market open, right? When market open, all you want to see is that you want to see market manipulate above its initial bias. The market will then continue moving in a preferred directional bias. For example, a bearish market on a daily time frame is this is how it's gonna be. And let's say you are trying to look for this particular day to be bearish. It means that the market will first manipulate up, right? Manipulate up. Then after that, you can see the market expand down. But this manipulation is important. This is be the word, the high of the day. Do you understand? So now, in that in London session, we have where you can anticipate this high of the day to happen. And that is where the London key zone comes in. Do you understand? So the London key zone, I will give you the particular time, specific time to be the London key zone. The time of the London key zone starts from what? From 2 a.m. to 5 a.m. So to know this is just to put your vertical line from 2 a.m. from 2 a.m. 2 a.m. to 5 a.m. Don't forget New York time. 2 a.m. to 5 a.m. New York time. So this is where you expect, if market is going to be bearish for a day, you expect the expansion should start around this particular time. This does not mean 2 a.m. to 5 a.m. is only the time for London session. This is just London key zone. So London session extend above 5 a.m. until even 7 a.m. New York time. But the time where you can actually get a better entry, can get the high of the day, can anticipate a better entry from there, is what is from 2 a.m. to 5 a.m. Do you understand? So that is when we get our expansion from the what? From London session. And that is what ICT called London key zone. And don't forget, London session is still one of the best trading session, right? It's one of the best trading session compared to New York. And do you know why? London session, if markets, two things will happen during London session. If market is going to be bullish, right, then you expect that market will be bullish from that London session. All you just need to do is when market open, right, when market open, you wait to buy below the opening price, since we're talking about bullish market right now. So if you buy below the opening price, the market can expand, and during New York, market can continue by using the range of New York to continue the buy. So by then, for you to get your entry at the week that is below or at the opening price, it means that you have a better entry for that particular day. Even if New York is going to manipulate, at least it's going to leave this particular low. So it's the pairs that are advisable to trade during London session are GBP USD and Euro USD. Basically, they are ideal for this time of the day. Right. So when you open, I think we should just check one or two examples on the opening price in London. So, okay, okay, let's see if we have a better opportunity. I think this is a low. Let me check if it's a low we can. Right. Okay, good. This is a level of liquidity, definitely. So when this happens, when this happens, we are supposed to expect market to rebound, right? To rebound back at least, even if market is still bearish, to seek a liquidity above a weekly level or a daily level should give you a rebound. That is, the market need to move back to our to internal liquidity before market continue the expansion. So using that as a sample, so we know that this particular day should be bullish. Okay, let me apply the daily break event, session break. Good. Do you understand? So this happened, happened a day before this day. So now, since you know the market have already seek the sell side liquidity and you want to look for buying opportunity, what do? You always want to buy below the opening price. So this is where market opened. So definitely you should expect a manipulation below. And luckily for you, there is a nice order block here, right? You have a nice order block here, right? And then let's put our session. The time for New London kill zone is 2 to what? 2 to 5 London time. You can see that now. Let me change the color to something that is not going to get us confused. Good. So this is the time period. And we see that we have this particular demand or order block. But not just at any time. Look at the time the market is coming to mitigate that particular order block. And you see what? You see market expand from there. So this become the what? The low of the day. Definitely. So this is the time. So we can check for one example again. I think there are many examples here actually. Many examples. So I think let's use this one. So this is when the market open. And to be a seller, it is always advisable to sell below what? To sell above the opening price. So this is where the market opened. And this is what? The opening price of the market at that day. This is the opening price. Right? Now, if you put in your time, if you put in this is 2 a.m. towards to 5 a.m. That is where you get your what? Your trade. You can see. And guess what happened? We have an inefficiency here. As a matter of fact, confluencing with what? With a mitigation block below here. But just the right timing. You understand? The right time. This is not when you get inside the market. This is when market open. But all of this period, they are not when you enter the market until the what? The London key zone. And you can see that it's always the what? The high of the day. This was almost late self. But you can see that we always have the high of the day at that particular price level and time. From what? From 2 a.m. to 5 a.m. New York time. That is when you expect the high of the day to form. So this is forming the week of market that we are expecting to close bullish. So the week, if you enter from this particular, it means that you've entered from the week. So if you go to daily time frame, you will see the market will reject and it looks like a sniper entry because you just enter from the what? The high of the day. So and from there, the market will get and expand lower. Do you understand? So there are some times that London session might actually not give you what you are expecting in terms of directional bias, and that is where New York comes in. For example, you might be looking to be bullish, you might be looking to be bearish on the pair, and during London session, market start buying. All you just need to do is expect a reversal from New York. And I think there are other examples here. Let's check. Okay, look at this now. Ideally, we still bearish on this particular day, because I'll take you back, because this is the trade that I held. If you my current swing, yeah, so it's actually a bearish market, right? So all you need to be doing is to be looking for sales opportunity. But now I will show you another thing. So this is where market open. So ideally, if you want to be looking for sell, it's just above the opening price. So if the market even sell before, you still need to wait above the opening price to have a better trade. So by then you know that at least you are selling from the week. You're not just entering your trade blindly. So now, if we put our time, market open here, let's put our time zone, London key zone. Tell me again, from what? London key zone this is London key zone from 2 to 5. You can see now. You can see from 2 to 5. What happened there? Market expanded, but it was actually bullish. We are expecting a sell. But there's one thing I want you to pick from here. Regardless of where the market is going to, whether the market is moving in your directional buy or is not, there's something that is common in this particular time: expansion. The fact that you're expecting a sell, but then at that particular time level, there's still there's still a liquidity above the opening price, and you still expect market to move here. So what happened? The London expansion was to move to that your opening price before we have the continuation, maybe from New York. But one thing is constant. You can see that even when market is not giving you your trade to go in your bias, you still have that expansion, that time of the day. That is what I want you to understand. That particular time that you still have this expansion in that particular time. So let's see if we can see another one. This is the opening of this particular day for market that is still bearish. This is the opening. So if you look at the time from 2 to what? To 5, London what? Key zone. You can see what happened. We're expecting a sell, right? But look at what happened there. Market expanded during that particular London time. We have our expansion, but then not in the direction that we intend to go in that particular day. But what I'm just bringing out is that at this time period, I'm telling you, you can see it is just from 2 to 5, from 2 to 5, from 2 to 5. The expansion is always there. You always have it. You can see market expanded, and I think New York time, the market rated the liquidity above all of this, including the London session high, and we have the major expansion to the downside. Do you understand? So these are time that you can always go to the chart to look for trade opportunity. You just don't open your chart and start looking for trades. Timing is important, and that is why we are here today. Time and price. The time at 2 to what 5 a.m. at what price above the what opening price you look to sell. Timing 2 to 5 at what price above the opening price you look to sell. So that is how to anticipate and how to trade on London session. Okay. So moving on, and before that, another thing you need to understand is in some cases you might just need to study the price action in London session. Do you understand? For example, now sometimes you might have a very big expansion during the London session. So what you'll be expecting in New York might not be a continuation. New York might be busy or might be silent. For example, you have a very big expansion during the London session. So New York session, you are expecting a continuation. You might be wrong because it is possible that during London session, market can expand to cover the average daily range of that particular pair. You know that there's average daily range expansion for every pair if you study them. So, for example, GBP USD, Euro USD, GBP USD average expansion is like 50 pips in a day. So Euro USD is still within that 40 to 50 or 60 pips too. You understand? So it's possible that you might have an expansion during London session that will even what? That even be above 50 to 60 pips in some cases. So in that kind of period, you don't go to New York session to start looking for trade opportunity because you might be trapped. You might get a reversal and market might tend to actually consolidate during New York. So let's just move and talk about the New York key zone on its own too and its characteristics. Now, moving on to New York key zones, right? The New York key zone, let's first talk about the pairs that are suitable for this type of period are still like the major pairs. Do you understand? Like the Euro USD, or USD, USD card. Those are pairs that are very okay to be traded on New York session, where you can also use the New York key zone to get in your what? Your trade or your entry. Do you understand it? And New York key zone can offer maybe 20 to 30 pips cap. Yeah, 20 to 30 pips cap. You can still get into 30 pips, but London can still give you up to like maybe 50 pips. Do you understand? That is why I say London is still the most tradable session in terms of orders present in that particular session. So now moving on to New Yorkism, what time should I be expecting an expansion in New York? I don't know if I've made a video on OTE. If I have not, I would in the next video, right? So now, New York time is what which is New York key zone is what is the time is from 7 a.m. to what 7 a.m. to what to 9 a.m. New York time 7 a.m. Sorry, to 9 a.m. New York time. Do you understand? This is when you should expect your expansion from what? From New York. Just like I was showing you for London session, you have the time where the markets move better, and that is when you can have a better entry. The same thing on New York. Do you understand? So I want New York can only give you two scenarios, right? It's either you see a continuation from what? From London session, or you what? Or you get a reversal. Do you understand? Either you see a continuation, or you get a what? Or you get a reversal. And the only thing, another advantage of New York is that this is the time frame where we get most news. Most of our high impact news, do you understand? They are always during New York. So that is like one thing you have on New York. So you might maybe your NFP, CPI, FOMC, all of these high impact news, even medium impact news, most of them are always on what? On New York, just to push market well. So that's one thing about it. So talking about the two scenario you can get from New York. It's either you get a continuation from London, or you get what? An expansion. A reversal. Reversal in the sense that you know that from London, we have the market being bullish. Meanwhile, you're actually bearish. Just like the example I showed on the London session. So New York did what? The reversal. So let's quickly check the two example. I think I gave more than two examples. I gave like three examples. If we can get the same thing. Now, looking at here now, let me change this color to another color for what? Which color? Yellow. Yeah, let me use yellow. No, now, if you take this, what do I call the time again? 7 a.m. to what? To 9 a.m. New York time. Please don't forget. So now, 7 a.m. This is 8 a.m. This is 7 a.m. to what? To 9 a.m. Right? 7 a.m. to 9 a.m. So here now, we have the word continuation. New York has already formed high of the day, right? Expanded. Then, London formed high of the day, expanded. The New York time, look at the time, you have the what? A correction back as OTE, which means that the swing from the London session is what you will use for the continuation. So the swing from the London session is what you will use for the what? For the continuation. All you just need is what? Is to measure it and you trade like 60% of this swing. That is when you get your continuation as OTE. You understand? So when you are looking for continuation in New York, you should always expect market to you should always expect your expansion from the what? From the expansion that happened during what? During London. So above 61.8 retracement fib level is always a nice area, especially if it's a fair value gap confluencing with any reference point again, then you can have expansion. So you see, this is what happened here. The same timing, I see market. Because this happened late, even this particular New York retracement too also happened late. But at the end of the day, just entered fair value gap here and the other block, and you had the expansion of that day. Right? Especially when the market has not delivered towards to sell side liquidity. Do you understand? There's a way we trade what is it called? OTE, although I'm going to explain better in another video, but not here. This is just to talk about the time of the day you should look for opportunity at what price level and the like. So when you have market approaching a daily low, when market is bearish, these are period you can use the idea of OTE to do what? To target the low, to target that particular low of that day. There are two ways to doing that, but we'll do that later. So this is an example of where you get a continuation. But looking at this point now, we get a reversal instead. can happen in New York. Why? Because we've been trying to look bullish. That's why I said sometimes you need to study the price action on the London session before you even know what to do on New York. So looking at the price action in London session, already you know that London was not ready to push price lower, but it happened that London was able to push to deliver a liquidity above the opening price. Then from there, New York can reverse. And if you look at the time, 7 to what? To 9, you can see 7 to 9, you can see what happened. Okay, just raided and grab liquidity above this London high, just small. You can see market deliver, and that is the high in that New York. Do you understand? Then market reversed. So these are examples of time where New York will happen to be reversed. That is that you are expecting market to climb during London, but London actually did what? Did something else by pushing the price to a better level to look for sell opportunity. So London has done its job already. So it's New York to move the price in the normal direction. You understand? So moving on, if you look at more again, this is another one. The same thing here, but London happened to be what? To reverse. I mean New York reverse. Let's check the time. Where is it? 7 to what again? So 9. You can see still inside this particular room. What you just do is what market just traded above all of the London high and every other high above opening price. Then you have a what? You have another block from a what? From a breaker. And that is where you have the high. And market expanded. You can see that the fact that London did not actually expand well, such that London was just to manipulate or to push price higher to where market will drop. You can see that the expansion was now much compared to when London actually did a good expansion. The same thing here too. London happened to be the expansion, New York expansion. You can see our market move. Look at this one too. London expanded, but New York we just retraced back to a fair value gap there. The market dropped. It's more or less like this is just normal movement. There's a normal expansion, not really big. But in the period whereby maybe London did not move, maybe just consolidate and stuff, we can see the major expansion in New York. And you can see the timing. You can see that every time the key zones are where we always have the start of the expansion. New York, you can see. New York, you can see. New York, you can see. London, you can see. New York, London. This is London. You can see the expansion. London, New York. Yeah, so these are the time to look for trade opportunity in the market, right? So that is about New York and London key zones. And it doesn't mean that only 7 a.m. to 9 a.m. is the only time for New York. New York also extend above 7 to 9 a.m. even until 2 p.m. New York time. But these are just the key zone where we get our what? Our entries. So, and I've given you example enough. I think, let me check. Okay, I think let's look at this again. This we already have market expanded from this particular low, which is the what? Below the opening price at what time? At 3 a.m. And we know that the New York is in within 2 to what? To 5. So we have our major high of the day, at the low of the day expanded. Then doing New York, come on, see again. New York, we have 7 to what? To 7 to 9. You can see again that this retracement ended at what? At this particular level, just to do what? To mitigate other blockade by using what? The range that happened, the expansion that happened during London session. and we can see how market just what return back until that particular time enter this particular favor. You see how the timing and the price are working out here. This is already there. So the market has been here, not moving until this particular New York time. And market entered what? Above or below 61 retracement feed level. And we have the what? Your HOCL. Don't forget, especially when market has not rated previous day's high. Yeah. So we have this, the market expanded again. So that is how to use New York time and price. And I believe I've been able to give you enough details that you need to understand the concept of time and price, how to get in your trade, where to get better entries, the particular pairs, the suitable pairs you can trade during this time of the day. So I remain LPT. I'll see you guys in the next video. Take care.